In February 2022, the European Union made what seemed like a decisive power move. As Russian forces crossed into Ukrainian territory, Western nations mobilized not just military aid and diplomatic condemnation, but something far more tangible: financial warfare on an unprecedented scale. Within days, the EU, alongside the United States, Canada, and other allied nations, froze approximately $300 billion in Russian central bank reserves. Of this staggering sum, roughly $105 billion sat locked within European financial institutions, primarily in Belgium, France, and Germany. The message was clear: economic isolation would cripple Moscow's ability to finance its military operations and force a strategic retreat. This wasn't the first time that asset freezes had been deployed as geopolitical weapons. Sanctions have long served as tools of statecraft, used to punish rogue regimes, deter aggression, and signal international disapproval without firing a single shot. But the scale of the 2022 asset seizure marked a watershed moment. Never before had the reserves of a major nuclear power and permanent UN Security Council member been frozen in such magnitude. European leaders framed the move as both morally necessary and strategically sound, a way to hold Russia accountable while cutting off the financial oxygen feeding its war machine. Yet beneath the surface of this bold declaration lay a complex web of legal ambiguities, economic interdependencies, and geopolitical calculations that would soon begin to unravel. The frozen assets were not simply confiscated; they remained technically Russian property, held in legal limbo. European institutions found themselves in uncharted territory. How do you weaponize money without violating the foundational principles of property rights and international law that underpin the global financial system? The answer, as it turned out, was far more complicated than anyone anticipated. By mid-2023, cracks in the strategy began to emerge. Rather than buckling under pressure, Russia pivoted with remarkable speed. Moscow announced a series of countermeasures that sent shockwaves through European boardrooms and government ministries. Russian authorities moved to seize European assets within its borders, targeting everything from corporate holdings to real estate investments. Major European companies with operations in Russia suddenly found themselves facing expropriation orders. Energy contracts were torn up. Intellectual property rights were suspended. The message from the Kremlin was equally clear: if Europe could freeze Russian assets, Russia could nationalize European investments. The scale of European exposure was staggering. Decades of economic engagement had woven European capital deeply into the Russian economy. German automakers had built sprawling manufacturing facilities. French energy companies held stakes in strategic projects. Italian luxury brands operated flagship stores in Moscow and St. Petersburg. Dutch, Austrian, and Finnish companies had invested billions in infrastructure, telecommunications, and consumer goods. When Russia began seizing these assets, the financial pain was immediate and severe. Initial estimates suggested that European companies stood to lose upwards of $50 billion in direct investments, nearly half of what the EU had frozen. But the retaliation extended far beyond simple tit-for-tat asset seizures. Russia began restructuring its financial architecture to operate outside Western systems. Trade settlements with China, India, Turkey, and Middle Eastern nations increasingly occurred in rubles, yuan, or local currencies, bypassing the dollar and euro entirely. Russian banks, cut off from SWIFT, developed alternative payment networks. Moscow accelerated its long-term strategy of de-dollarization, a process that had been underway for years but now took on urgent momentum. The frozen assets, rather than weakening Russia's hand, became a rallying point for nations wary of Western financial dominance. The European Union soon discovered that financial warfare is a double-edged sword. The freezing of Russian assets was meant to demonstrate the power and unity of the Western alliance. Instead, it exposed fundamental vulnerabilities in the architecture of global finance. Central banks around the world, from Beijing to Riyadh, from New Delhi to Brasilia, took note. If Russian reserves could be frozen today, whose assets might be frozen tomorrow? The precedent was unsettling, particularly for nations that held substantial foreign exchange reserves in dollars and euros. Trust, the invisible currency that lubricates international finance, began to erode. As winter approached in late 2023 and early 2024, Europe faced another uncomfortable reality. Energy dependence had not disappeared simply because policy had changed. While liquefied natural gas imports from the United States and Qatar partially filled the gap left by Russian pipeline gas, prices remained elevated. European industries, particularly energy-intensive sectors like chemicals, steel, and fertilizers, struggled with input costs that were multiples higher than their competitors in Asia and North America. The economic competitiveness of the European manufacturing base came under severe strain, and questions began to emerge whether the costs of the sanctions regime were being borne disproportionately by European citizens and businesses. Meanwhile, Russia's economy, while certainly pressured, proved more resilient than many Western analysts had predicted. High energy prices in 2022 and early 2023 generated windfall revenues. Trade reorientation toward Asia provided alternative markets for oil, gas, and commodities. Domestic production ramped up in sectors previously dominated by imports. The ruble, after an initial collapse, stabilized. Inflation, though elevated, was brought under control through aggressive monetary policy. The narrative of economic collapse that had dominated Western media in the early months of the conflict gave way to a more sobering assessment. Russia had adapted.
The European Union's initial confidence in the asset freeze strategy rested on a critical assumption that financial pressure would translate directly into political capitulation. This logic had worked, to varying degrees, in previous sanctions campaigns against Iran, North Korea, and Venezuela. But Russia in 2022 was not Iran in 2012. The Russian economy, while smaller than the collective EU economy, possessed structural characteristics that made it uniquely resistant to financial isolation. Chief among these was its status as a commodity superpower. Russia didn't just export energy, it was a dominant global supplier of natural gas to Europe, a major oil exporter, a leading producer of wheat and fertilizers, and a critical source of industrial metals, including palladium, nickel, and titanium. This commodity dominance meant that while Europe could freeze Russian financial assets, it could not easily freeze Russian economic leverage. When Brussels moved to lock down $105 billion, Moscow still controlled the valves on pipelines that heated European homes and powered European factories. This asymmetry, financial power on one side, commodity power on the other, created a standoff where both parties could inflict pain, but neither could deliver a knockout blow. European policymakers had underestimated the degree to which their own economies remained structurally vulnerable to Russian resource exports, particularly in the energy sector. As 2023 progressed, the legal dimensions of the asset freeze became increasingly problematic. International law distinguishes clearly between freezing assets, a temporary measure that leaves ownership intact, and seizing assets, which involves permanent confiscation. The EU had frozen Russian reserves, but European leaders began discussing whether those assets could be seized outright and transferred to Ukraine for reconstruction purposes. The moral case was compelling. Using Russian money to rebuild what Russian forces had destroyed seemed like poetic justice, but the legal case was far murkier. Property rights form the bedrock of the international financial system. When investors, whether private companies, sovereign wealth funds, or central banks, place money in foreign jurisdictions, they operate under the assumption that those assets are legally protected except in cases of criminal activity or clear judicial process. Arbitrary seizure, even in the context of geopolitical conflict, threatens this foundational principle. Legal experts within European governments warned that confiscating Russian reserves without a clear legal framework could set a precedent that undermines the rule of law and damages Europe's reputation as a safe haven for international capital. Yet the political pressure to do something with the frozen assets intensified. Ukraine's reconstruction needs were enormous. Estimates ranged from $400 billion to over $1 trillion, depending on the scope and timeline. European taxpayers were already shouldering significant costs through military aid, humanitarian assistance, and energy subsidies. The idea of using Russian money to fund Ukrainian recovery had obvious political appeal. In late 2023, the EU began exploring compromise solutions. Rather than seizing the principal amount of frozen assets, European institutions would capture the interest and investment returns generated by those funds and redirect them to Ukraine. This middle path seemed legally safer than outright confiscation, but it still carried significant risks. Russia immediately declared that any use of proceeds from frozen assets would be treated as theft and would trigger equivalent countermeasures. Moscow's response was swift and multifaceted. Russian courts issued rulings allowing for the seizure of European corporate assets in Russia, with priority given to countries most aggressive in supporting the asset freeze. German industrial firms were hit particularly hard. Automotive plants, machinery manufacturers, and chemical facilities faced expropriation orders. The legal justification provided by Russian authorities mirrored European arguments. Extraordinary circumstances warranted extraordinary measures. The corporate dimension of the conflict added layers of complexity that governments had not fully anticipated. When states sanction other states, the battleground is relatively clear. But when corporate assets become collateral damage in geopolitical disputes, the calculus changes. European companies with Russian operations suddenly found themselves trapped between their home government's foreign policy objectives and their own commercial interests. Shareholder lawsuits began to pile up, insurance claims were filed, international arbitration proceedings were initiated. The legal and financial fallout created a morass that would take years, possibly decades, to fully resolve. Beyond Europe's borders, the asset freeze was having unintended consequences that rippled through the global financial system. Central banks in emerging markets began quietly diversifying their reserve holdings away from dollars and euros, seeking assets that couldn't be frozen on political grounds. Gold purchases by central banks surged to levels not seen in decades. Interest grew in alternative reserve assets, including the Chinese yuan, though concerns about capital controls and transparency limited its appeal. Some nations explored holding reserves in physical commodities or expanding bilateral swap arrangements that bypassed Western financial infrastructure entirely. The precedent established by the Russian asset freeze became a talking point in geopolitical forums far removed from the Ukraine conflict. When Western nations lectured others about rule of law and property rights, critics pointed to the frozen Russian reserves as evidence of hypocrisy. China, in particular, leveraged the situation to advance its narrative about Western financial hegemony and a need for a more multipolar global order. Beijing accelerated efforts to internationalize the yuan and develop alternative payment systems that could operate independently of Western oversight. The irony was stark. A policy designed to isolate Russia was unintendedly accelerating the fragmentation of the global financial system that had served Western interest for decades. By early 2024, European officials were engaged in difficult internal debates about the path forward. Some argued for doubling down, seizing the full $105 billion and accepting whatever consequences followed. Others advocated for a more cautious approach, using only the investment returns while keeping the principal frozen but intact. Still others began quietly exploring off-ramps. Could some portion of the assets be unfrozen in exchange for specific Russian commitments? The unity that had characterized the initial response to the Ukraine invasion was fraying under the weight of economic realities and divergent national interests. Poland and the Baltic states pushed for maximum pressure. Germany and Italy, with greater economic exposure to Russia, urged restraint. France sought a middle path that preserved European strategic autonomy while avoiding permanent rupture with Moscow.
The structural transformation of global trade patterns represented perhaps the most profound and lasting consequences of the asset freeze confrontation. Prior to 2022, the international financial system operated largely through a dollar-centric architecture built over 7 decades of American economic dominance. The euro served as a secondary reserve currency, and European financial centers, London, Frankfurt, Paris, Zurich, functioned as critical nodes in the global flow of capital. This system delivered enormous advantages to Western economies: the ability to borrow cheaply, to enforce compliance through financial pressure, and to set the terms of international commerce. The freezing of Russian reserves threatened to undermine this entire edifice, not because the policy failed, but paradoxically because it succeeded in demonstrating just how weaponized Western finance had become. Russia's pivot toward Asia was not merely a matter of finding alternative customers for its oil and gas. It represented a fundamental reorientation of economic relationships that would reshape Eurasian commerce for generations. Trade volumes between Russia and China exploded, growing by more than 40% in the first year following the asset freeze. Energy deals were restructured to settle in rubles and yuan rather than dollars. Russian liquefied natural gas found eager buyers in India, where energy demand was surging alongside economic growth. Turkey positioned itself as a crucial intermediary, facilitating trade flows that Western sanctions were designed to block. The United Arab Emirates and Saudi Arabia, while officially aligned with Western security frameworks, proved pragmatic in their commercial relationships, maintaining robust economic ties with Moscow, even as diplomatic rhetoric remained carefully calibrated. This diversification carried significant implications for European energy security and industrial competitiveness. The continent had grown dependent not just on Russian gas, but on the pricing structures and infrastructure networks that accompanied decades of energy partnership. When those relationships ruptured, Europe was forced into a frantic search for alternatives that proved both expensive and logistically complex. Liquefied natural gas shipments from the United States, Qatar, and Australia filled some of the gap, but at prices substantially higher than piped Russian gas had cost. European industrial giants, chemical manufacturers, steel producers, fertilizer companies suddenly found themselves competing with Asian rivals who enjoyed significantly lower energy input costs. Plant closures and production curtailments followed, concentrated particularly in Germany's industrial heartland and Italy's manufacturing centers. The political ramifications within Europe intensified as economic pain became more widely distributed. Energy subsidies to protect households and businesses from skyrocketing utility costs consumed tens of billions of euros from national budgets already strained by pandemic spending and demographic pressures. Inflation surged across the continent, reaching levels not seen since the early 1980s. The European Central Bank faced an impossible dilemma: raise interest rates to combat inflation and risk triggering recession, or keep rates low and allow price pressures to erode purchasing power and savings. The policy response oscillated uncomfortably, satisfying no one and generating political backlash from both left and right. Meanwhile, the frozen Russian assets sat in European financial institutions, generating questions that grew more uncomfortable with each passing month. The funds were held primarily in Belgian depositories, managed through Euroclear, the Brussels-based financial services company that serves as a central securities depository. The investment returns on these assets, estimated at several billion euros annually, became a focal point of intense negotiation. European officials argued that these returns should be channeled to Ukraine, compensating in some measure for the destruction wrought by Russian military operations. Moscow countered that any appropriation of returns constituted theft and would be met with equivalent retaliation against European interests. The legal architecture supporting the asset freeze was tested repeatedly in European courts. Russian entities and individuals whose assets had been frozen filed lawsuits challenging the legality and proportionality of the measures. European judges faced complex questions about the balance between foreign policy imperatives and property rights protections. Some cases were dismissed on grounds of sovereign immunity or national security. Others proceeded through lengthy judicial processes that would take years to resolve. The legal uncertainty created a chilling effect on international investment, as governments and private entities alike began to question whether European financial centers could be trusted to respect property rights when geopolitical tensions escalated. Russia's countermeasures extended beyond simple asset seizures into more sophisticated forms of economic warfare. Moscow leveraged its position in global commodity markets to create supply pressures in sectors where European dependence remained acute. Palladium exports, critical for automotive catalytic converters, were restricted. Titanium supplies, essential for aerospace manufacturing, faced export controls. Weed shipments, while not directly curtailed, were routed through channels that maximized Russian leverage and minimized European influence. These measures were calibrated carefully, severe enough to inflict economic pain, but measured enough to avoid triggering escalatory responses that could spiral into direct military confrontation. The ideological dimension of the conflict also deserves attention. Russian media and government spokespersons framed the asset freeze as evidence of Western neocolonialism and financial imperialism. The narrative resonated particularly strongly in the global South, where memories of IMF structural adjustment programs and Western-imposed austerity measures remain fresh. When Moscow positioned itself as a victim of arbitrary Western financial power, it found sympathetic audiences in Latin America, Africa, and parts of Asia. This narrative battle mattered because it shaped international opinion about who bore responsibility for global economic instability and whether Western financial institutions could be trusted as neutral custodians of international capital. European unity, so evident in the initial weeks after the invasion of Ukraine, began to show visible strain by mid-2024. Hungary, led by Prime Minister Viktor Orban, openly challenged the sanctions regime and maintained close economic ties with Russia despite pressure from Brussels. Austria and Slovakia, heavily dependent on Russian energy, sought exemptions and carve-outs from the most stringent measures. Even Germany, historically the anchor of European consensus on major foreign policy questions, saw growing domestic opposition to sanctions policies as energy-intensive industries struggled and household utility bills soared. The gap between stated policy objectives and economic realities became increasingly difficult to bridge. The question of what victory looked like in this economic confrontation remained stubbornly undefined. If the goal was to force a Russian military withdrawal from Ukraine through financial pressure alone, the policy had clearly failed. If the objective was to degrade Russia's economic capacity over the long term, the results were mixed at best. Russian GDP contracted, but not cataclysmically, and adaptation mechanisms proved more robust than anticipated. If the purpose was to send a signal to other potential aggressors that territorial conquest carries unsustainable costs, the message was undermined by Russia's ability to withstand and adapt to the pressure. Strategic ambiguity about objectives made it nearly impossible to assess whether the asset freeze was succeeding or failing, and this ambiguity fueled growing doubts about the sustainability of the approach.
The broader implications of the asset freeze controversy extend far beyond the immediate Russia-Europe confrontation, touching fundamental questions about the future architecture of global finance and the balance of power in the 21st century. What began as a targeted response to military aggression evolved into a stress test of the entire post-World War II financial order. The institutions that had governed international capital flows for decades, the International Monetary Fund, the World Bank, the Bank for International Settlements, suddenly found their authority and neutrality questioned. If Western nations could freeze the reserves of a major power based on foreign policy disagreements, what prevented similar actions in future disputes? The precedent, once established, could not easily be contained or limited to exceptional circumstances. China observed these developments with particular attention, drawing lessons that would inform its own strategic calculations for years to come. Beijing accelerated its development of the cross-border interbank payment system, a yuan-denominated alternative to SWIFT designed to process international transactions outside Western oversight. Chinese policymakers intensified efforts to reduce the country's holdings of dollar-denominated assets, diversifying into gold, commodities, and strategic resource investments across Africa, Latin America, and Central Asia. The message from Beijing to its own population and to international partners was clear. Reliance on Western financial infrastructure represented an unacceptable vulnerability that must be systematically reduced. The asset freeze intended to isolate Russia inadvertently provided China with a powerful justification for accelerating the fragmentation of the global financial system. For European policymakers, the question of how to proceed with the frozen assets became increasingly fraught as time passed without clear resolution to the underlying conflict. The initial legal and moral clarity that justified freezing Russian reserves grew murkier as months stretched into years. Ukraine's reconstruction needs remained urgent, but using frozen Russian assets to address those needs without proper legal authority risked undermining the very rule of law that European institutions claim to defend. Proposals to establish an international compensation mechanism, perhaps administered through the United Nations or a specially created tribunal, foundered on Russian and Chinese opposition and the practical difficulties of establishing legitimate legal authority for what would amount to forced wealth transfer. The economic costs of the prolonged standoff accumulated in ways both visible and hidden. European companies that had invested in Russia wrote off tens of billions in losses, dampening enthusiasm for future international expansion and making corporate boards more risk-averse about emerging markets generally. Insurance premiums for political risk coverage surged, raising the cost of international business and reducing the competitiveness of European firms in global markets. The brain drain of skilled Russian professionals and entrepreneurs to neutral countries like the United Arab Emirates, Turkey, and various Asian nations represented a long-term human capital loss that would be difficult to reverse even if relations eventually normalized. These second-order effects, harder to quantify than frozen assets or seized properties, nonetheless represented significant drags on economic dynamism and growth potential. Public opinion within Europe reflected the complexity and contradictions of the situation. Polls showed strong support for assisting Ukraine and opposing Russian aggression, but this support coexisted uneasily with growing frustration about high energy prices, inflation, and economic stagnation. Political movements on both the far right and far left exploited these tensions, arguing that European leaders had subordinate national economic interests to American geopolitical objectives. Mainstream parties found themselves caught between competing imperatives: maintaining solidarity with Ukraine, preserving transatlantic unity, protecting European economic interests, and responding to legitimate domestic concerns about living standards and competitiveness. The political space for nuanced policy grew narrower as polarization intensified. The global energy transition added yet another layer of complexity to the unfolding dynamic. European nations had committed to ambitious climate goals requiring rapid reduction in fossil fuel consumption and massive investment in renewable energy infrastructure. The rupture with Russia, paradoxically, both complicated and accelerated this transition. In the short term, Europe was forced to increase imports of liquefied natural gas and even temporarily extend the operating lives of coal plants to ensure energy security. But the crisis also created political momentum and financial commitment for renewable energy development that had previously faced implementation delays and funding shortfalls. Solar installations, offshore wind farms, and energy storage systems received unprecedented investment as Europe sought to reduce structural dependence on imported fossil fuels. Whether this accelerated transition would ultimately vindicate the costs of the Russia confrontation remained an open question. Russia's adaptation to financial isolation proved more comprehensive than most Western analysts had anticipated. Moscow developed workarounds for nearly every sanction imposed, from parallel import schemes that rerouted consumer goods through third countries to the creation of shadow tanker fleets that transported oil outside the visibility of Western tracking systems. The Russian tech sector, cut off from Western suppliers, pivoted toward Chinese alternatives and accelerated domestic development of critical systems. Russian agriculture, benefiting from import restrictions that had been imposed even before the Ukraine conflict, achieved near self-sufficiency in key food categories. These adaptations came with costs, efficiency losses, quality compromises, technological lags, but they demonstrated a capacity for economic resilience that challenged the assumption that financial pressure alone could produce strategic capitulation. The institutional damage to international financial governance may prove the most enduring legacy of the asset freeze controversy. Trust between nations operates on timescales measured in decades and centuries, built gradually through consistent behavior, and eroded rapidly through perceived betrayals. When central banks around the world contemplated where to hold their foreign exchange reserves, the freezing of Russian assets introduced a new variable into the calculation: political risk in what had previously been considered the safest jurisdictions. The gradual diversification away from dollar and euro reserves, already underway before 2022, accelerated as central bankers from Sao Paulo to Jakarta reassessed their assumptions about asset security. This diversification, occurring incrementally across dozens of countries and hundreds of billions in reserves, represented a tectonic shift in global finance that would reshape power relationships for generations. As the situation evolved through 2024 and into 2025, no clear resolution emerged.
the frozen Russian assets remained in legal limbo, subject to ongoing litigation and political negotiation. European companies continued to write off losses from seized operations in Russia, though some maintained skeleton presence hoping for eventual normalization. Ukraine's reconstruction proceeded slowly, funded primarily through Western aid packages rather than Russian asset seizures. The energy market stabilized at a new equilibrium with higher prices and more diversified supply chains. Russia's economy neither collapsed nor thrived, settling into a pattern of moderate contraction ameliorated by commodity revenues and import substitution. The lesson drawn from this complex saga depends heavily on perspective. European and American officials pointed to Russia's isolation from Western financial systems as evidence of successful deterrence and appropriate response to aggression. Russian authorities characterized their adaptation and survival as vindication of strategic autonomy and resilience to Western hegemony. Neutral observers saw a fragmented global economy becoming increasingly divided into competing blocs, with fewer shared institutions and reduced capacity for collective action on challenges requiring global cooperation. The $105 billion in frozen assets became less a tool of strategic pressure than a symbol of a broader transformation in international relations, away from the post-Cold War moment of Western dominance and toward a more multipolar, contested, and unpredictable global order. The true costs of the asset-free strategy would only become fully apparent over years and decades, as the second and third-order consequences rippled through systems that had seemed stable and resilient before the unprecedented financial confrontation between Russia and the West exposed their underlying vulnerabilities.